From the morning reading, the SPX continues down, the VIX rises and confirms. The Qs are weak on Facebook and Apple. More earnings per share winners and losers. 4 of 10 sectors moved higher on Thursday. XLE, XLU, and XLF were the strongest sectors, while XLK was again the weakest sector. While futures dropped 84 cents to close at 44.67, its lowest close since September 23rd. Breadth strengthened compared to the prior session as decliners led 1801 to 1198 on the New York Stock Exchange, and decliners led 1809 to 928 on the NASDAQ. The S&P 500 snapshot shows a rare 8-day sell-off. The S&P 500 posted another modest loss, extending its current sell-off to 8 sessions. The index opened fractionally higher and traded in a narrow range until the lunch hour, when it sold off to a narrow afternoon range in the shallow red. It then sank lower in the final hour to its negative 0.61% intraday low. Some buying in the final 15 minutes trimmed the loss to a negative 0.44%. The 8-day decline is now at 2.91%. As we mentioned yesterday, the last time we had an 8-day rout was in October of 2008. But the size of that sell-off was a gut-wrenching negative 22.80%. Should the S&P 500 extend the sell-off to 9 days, we'd have to go back nearly 36 years to December of 1980 for the most recent example, a 9-day decline of 9.37%. The 10-year note closed the session at 1.82%, up 1 basis point from the previous close. The S&P 500 is flirting with the long-term trend. The most widely benchmarked index in the world has approached its 200-day average for the first time in 90 days without yet violating it. When it has done that in the past, it has usually closed below the 200-day sooner rather than later, but then quickly rebounded. Volatility traders are betting that things will soon calm down. They piled into inverse VIX funds on Wednesday, adding more than 12% to their asset base. These have been smart money traders in the past, and volatility has had a strong tendency to decline in the weeks ahead. The VIX is getting stretched above trend. Those volatility traders are seeing that the VIX is more than 50% above its medium-term 50-day average, which is unusual when stocks have been doing so well. Every time this has happened in the past 30 years, volatility drifted lower going forward. After recently sitting at a 52-week high, crude oil has lost more than 10% in 10 days. Dating back to 1982, this has happened 16 other times. How traders reacted in the short term was telling. If crude rallied over the next week, then during the month following that, it continued to rally 5 out of 8 times, and 2 of those losses were less than 1%. But if crude continued to sell off over the next week, then following the next month, it rebounded only 1 out of 8 times, and 6 of those times it lost more than 5% in the ensuing weeks. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:58 a.m. Mountain Time, and I'm recording this in preparation for the market day of November the 4th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. So at the time of this cut, all 4 of the U.S. broad-based indices were rotating around scratch. Crude oil is up just above scratch, Euro's down just below scratch, bonds are up just a bit above scratch, and gold is down just a bit below scratch. So everything is basically frozen in place from yesterday's close on those U.S. related futures markets. Obviously, today is the day which we had the monthly employment report, one of the most important macroeconomic reports of the month, and I suspect that much of this is in wait for that report's release. And overseas action, bit mixed. China is down just below scratch, as is Hong Kong. but Japan down more significantly at 1.34%. Germany is also down nearly 1%, and the United Kingdom is down about 1.3%. Macroeconomic reports for today in the United States, in addition to the employment report, we have FOMC member Fisher speaking. That should occur after the markets close, but just be aware. And looks like everything is related to the employment report and its sub-information. In current volatility conditions, of course, things continue to heat up. Short-term VIX now at 27.9. We have not seen that kind of a number in quite some time. Skew is also significantly elevated. It's now 141.2, and that's enough for about a 13% probability that we're going to have a 2 standard deviation move within the next 30 trading sessions. The IV percentiles also continue to climb, and you see we've now gone on the S&P from that lower third all the way up into the upper third, and now coming in on a 70 on the annual range. The Russell right smack in the middle of the annual range at a 51, NASDAQ at 51, and the Dow at a 60. No standard deviation moves were put in yesterday by any of the U.S. broad-based indices on a close-to-close basis, though we continue to see some pretty significant intraday price action on some of these days. If you look at the last 2 rolling trading weeks, there's been no standard deviation moves, which is one of the things that's so unusual about this current 8-day sell-off. I don't know that we've ever had 8 days of selling and achieved so little in terms of downside. We're down about 2.9%, and we've managed to do that without a single session on the S&P being more than a standard deviation move on a single session on a close-to-close basis. The Russell's had some of those, but certainly not in the last 3 trading sessions. So this has been a very, very unusual kind of sell-off and period of weakness. In fact, let's go ahead and go to the charts. Okay, on the S&P futures chart, you see the important break of the key support, the confirmation of that, and then the continued deterioration thus far. Now, these candles, other than the break candle, haven't been terribly large, but even this one on a close-to-close basis wasn't more than a 1 standard deviation move. And so the question is where are we going now? Right now we're hovering around the 50% mark on the fib retracement, but it doesn't seem to be a bounce point at this point. Fridays are, before elections, usually aren't going to be an area of support. Obviously, a lot of this with new information coming into the market, such as that employment report, could be the inflection point by itself. If the employment report is met with, not seen as good news, we would likely fall to this 2061 area. The 618 fib retracement would be probably the next target. After that, if we don't see a bounce in the area between the 618 and about the 7 fib retracement, there's usually an area right there that can serve as support on fib retracements. If we don't see that happen, then we probably start gaining momentum towards the 100% fib retracement area. So that'll give you some ideas as to where this might go should we not find support. Next target, 2061. The next target after that, probably 1980. Now that's a significant area, and you think, what do you mean next target? Well, that's about 80 points between those. That's what we've been talking about in terms of the current hedge risk level, is that the conditions are right for a significant drawdown potential. Doesn't mean it's going to happen, but given the current erosion and the indication of all the various indicators, those are definitely the possibilities that are coming into play. Now, we talked yesterday about how the Dow was the most defensive of the indices and had been holding this horizontal support as of this point. And it's probed, but not yet broken this area. So we'll certainly watch this, and certainly we'll see where the employment report takes us when the cash market opened today. But the Dow is sitting right on key support. And the NASDAQ, of course, also is above key support, though it has been rapidly approaching that area in these last several sessions and is significantly weaker than it was some 2 trading weeks ago. But got to give the bulls some credit there in that they are still, in a relatively stronger area than is the S&P or the Russell. Now, the NASDAQ has deteriorated to the point where it's also below the cloud. So this is not a great place for it, and significantly changed its position, though not to the point that we have with the Russell. The Russell is approaching that 618 fib extension as well, and a break of that would likely also give a target of this 100% fib retracement. For the Russell, that would be the Russell futures, that would be 1075. So quite a bit of movement in these markets, albeit at a kind of a slow, withering grade down. Crude oil was one of the movers yesterday, and you see it at one point, it was down all the way to the 50% retracement overnight, also revisited that, has been bouncing off of that area to this point. We'll see if that can be an inflection point. One of the morning authors indeed mentioned about crude oil, and this it being a key area for crude oil. If we don't get a bounce here, it said something to the effect that the probabilities for significant additional move down was particularly high. So we need to see an inflection decision here in the crude oil market. If that doesn't happen, that could portend some significant weakness. Now, gold has been fighting up here against resistance the last 3 trading sessions, 2.5 trading sessions, including this one from last night's overnight. So we'll see where that goes. Right now, if the market continues to break down, you would expect that it would break through this and start to gather some energy and momentum as people start looking for safe haven status. So there's been a move towards gold. This is real in this short-term action here while the market's been weak. And yet at the same time, as I often ask, has it achieved anything? Well, right now, all it's done is taken a short-term move off of its kind of bottom here up to an area of resistance and hasn't broken through that resistance in any meaningful way. So, we haven't really achieved much, certainly. But if we should break through that, then we'll start calling into question, breaking through the cloud breakouts, and start looking at overhead resistance from diagonal lines, diagonal resistance, and horizontal resistance up here, having gone past many of the moving average lines. So a lot has happened in gold. It's the one market, perhaps, that we typically follow that has actually been achieving something of significance in much of this recent action. The dollar continues to show weakness. Now, obviously, we're coming into that employment report, and a very important report for the dollar as well. These candles have been getting smaller, looking for a loss or lack of energy and momentum at this point, but that could be speeding back up given if we get a particularly strong or weak report on the employment situation. And then let's take a look at bonds, the other place that people often go for safe haven status. We continue this sideways consolidation and really no indication or bias of direction at this point in the very short-term action. Obviously, the more intermediate term is clearly weakness and this great unwind with the interest rates and how that impacts long bonds. And then volatility. Volatility has been most interesting. While we've had a significant move in volatility in these last 2 rolling weeks, going from the 12 and handle now up, into the 22 handle. So that's nearly a doubling of the volatility price, and yet at the same time, we never even had one VIX spike, a 3-point difference between the close to close. So we've had, this one was actually close. You see here, The close here, roughly a 19.31, and the close here, about 22.1. So that was actually about 2.8. So this one was actually yesterday's session was the closest to a VIX spike that we've had in this entire movement. So bottom line, watch for the employment report, see which inflection that gives after about the first 15 or 30 minutes from that report, and especially once the cash market opens. That could be very telling for the rest of today and probably into Monday for the election. Now, obviously the election will totally dominate the conversation once the employment report is past us, and as various polls come out, and especially on key swing states, you could see some increasing volatility in front of those results until you start to actually get exit polls, and then you'll probably start to see some resolution of some of that volatility, depending on what happens. Now, if we have surprises in the market from the election, such as a Trump presidency, or a change in control of the Senate, or even more importantly, a change in control, and much less likely, a change in control in the House, those would have pretty violent swings on the market. But understand, that could go, a day or so past the election. Some of those races that end up deciding control might not be well understood for a day or two after the actual election is over. So this volatility is not necessarily over on Tuesday. This could bleed over into Wednesday, Thursday of next week. So just be prepared for that potential. That should be enough on the charts. Let's go ahead and go to the daily report. And we continue to see a sea of weakness here from all the various perspectives that we look at the market's condition. In the first order, the intermediate term phase opinion, still market phase 5. We are in the break of diagonal and horizontal support on our key S&P market. In terms of the three market timing signals, uptrend under pressure still holding, and the second signal, GMI index, still extremely weak at a 1 out of 6, a sell signal in place since 10-12. The third signal, coming from stock charts, decision point scoreboard, still very, very weak. Short term, neutral to bearish. Intermediate, almost in all locations, neutral to bearish. And then long term with mixed signals. So overall, the consensus of the three market timing signals is still for a neutral to bearish signal. Position sizing opinions remain at 50%, though if the VIX closes above a 24, that model will go to less than 50%. Incidentally, if the VIX goes over 30, that model calls for flat. In terms of the intermediate term market posture, a severely strong bearish signal with a weak bearish sentiment line reinforcing that, and you see the S&P now well below a 20 at a 12.1. The NASDAQ also well below a 20. The Russell about as low as it can get at a 4.0. Only the Dow is not below a 20, and it's just hovering just above at a 21.5. So these are all just about as weak as they can get on the intermediate term market posture. Hedge warning status is still level 3, which is our crash warning. This is a statement or opinion to the effect that the conditions are present for a significant downward move in the market. It's not necessarily a prediction or a high probability, but just a recognition that those conditions are present, and we need to be prepared for those outcomes with our portfolios. And one of the ways we prepare our portfolios is not initiating new bullish positions if you're a novice trader. And frankly, if you're an aggressive trader, you probably are looking more at bearish positions at this point, but being very, very nimble and looking for those reversal signs. We're going to talk about a couple reversal signs in just a moment, but option income strategies, cover calls, put selling, none of these are basically getting permission to trade opinions at this point. In terms of other warning areas, the volatility-based group, it's a sea of red. Everything has fired. One thing in terms of potential reversals, though, the volatility ratio warning has hit an excess level, so it's in position to reverse at any time for a reduction in volatility. Now, that hasn't happened yet, but we are in the zone to where we start to watch for those reversals. And so keep that in mind. Now, as other signals start to come in place and show reversals, that's going to be action triggers for some of our hedges to be removed, or maybe some of our short-term bearish trades to go ahead and take profits and be very, very quick to take those profits and be out, because in bearish times is when you can have some severe bullish moves. And obviously part of this is factored in with the timetable that's influenced by the election. So this current weakness, this slow motion weakness, could turn on a head pretty quick. So you got to be ready. Right now we have a sea of red, but we could literally have 3 sessions from now and much of this be going away. Distribution day count still very high. NASDAQ at an 8, S&P at a 7. Skew, we mentioned that earlier, all the way up to over 140. Current 10-day expected move, it's a warning if it's above 40. It's now currently above a 70. So just keep that in mind. What the market makers are pricing into premiums right now is that the S&P is expected to be somewhere between plus 70 and minus 70 in the next 10 sessions. In terms of, 10 days. In terms of the trend base, all 3 of those areas are warning. Once again, New York Stock Exchange, new high, new low. This time more than twice the level in which we would characterize that as in warning status. Risk aversion indicators, all 5, continue as risk off. Fear and greed index continuing to fall into the further extreme fear area, currently a 13. And when we look at the sector specific and we look at breadth, we see that there was some positive yesterday: utilities, energy, financials, not just positive as a sector, but the breadth within those, probably approaching 75% of the holdings were in those 3 sectors as a whole were positive yesterday, but quite a bit of red in many of the other sectors. Don't particularly see a strong theme of defensive versus risk on or high beta sectors at this point. It's kind of mixed, going both directions. One thing I will comment on is healthcare continues to get hammered. We could probably dive deeper into that, but if you're looking for bearish trades, healthcare would certainly seem to be one. Though if you were to get election surprise, healthcare could be one that snaps back in a very violent way. Market posture by sector specific is just about a sea of red here, with only transportation being up at all 3 time frames. In terms of percent change, again, we've been kind of focusing on the multiple time frames: 1 day, 5 day, 1 month, 3 month, and not a lot of consistency. In fact, there's no consistency, though financials are the closest thing to that across all those 4 time frames. Notice, though, the year to date on the financials, you're just above scratch on the year to date. So while financials has had some positive performance and some consistency in recent months, it's basically rotating around scratch for the year. Okay, that should be enough for today. Let's go ahead and wrap this thing up. What a week, right? So, but our videos do get longer when we have a lot of content, and especially when we're getting into hedge risk level 2 and 3. That's when perhaps some of these actions that we take are at their most important in the protection of our portfolios. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the full disclosure down here at the bottom can be found at this hyperlink. We'll be back here on Monday morning for the next session of the Falcon Global Market Preview. In the meantime, manage that risk, and everything else should fall into place for more consistent performance. Go learn something and have a great day trading.